Hey, what up, everybody? This is Startup Brothers number 8, ESPN The Ocho. We finally made it here. I'm Trace Cohen. This is actually my brother Maxwell. And we're the Startup Brothers. Maxwell Cohen. Yes, we still have the same last name. This way, we're still figuring that out. So it's been about 4 months since our last one. If you don't remember us, Trace Cohen, angel investor, startup founder, and have about 30 investments myself, 60 with my partner, early pre-seed, seed, lots of angel checks, lots of value add. It's a lot of fun. We love founders. And yes, we are in high tech.
My name is Maxwell, CEO and founder of Peelaway Labs. I started my company when I was in college about 7, 8 years ago, and we've been navigating the past decade and learning quickly and made it through the last few years, and we're striving for greatness.
And that you are. And so when we left all of you about 4 months ago, since we did our last podcast, I was actually going through it, and it's actually called kind of like layoffs, predictions, and fundraising. And so 4 months ago, wow, 2022, I still can't believe we're like 2023. I saw the check today, and I almost put 2022 on it. This was basically Q4, and we only made, myself, 4 investments last year. Something spooked me, my partner, and early in 2022, we just slowed down. It was something that, as I like to say, we're like scouts for the Series A's and B's, and they start to slow down. They started to do more diligence, which is good and bad, as we'll discuss as well. And it just felt like the world was falling apart a little bit. And now we've kind of come for full circle to see. We last talked about like the Googles, the Microsofts, and all these companies were massive, $1 trillion. Still can't even fathom like how many zeros that is.
So from our perspective, the startup perspective, I know everything on your side seems like it was going down, but everything from our side seems like it was going up in the funniest way. All the execution we've done over the past 2 years of refining, fine-tuning, getting smarter, the heartaches, layoffs, which is all true. We saw our supply chain costs and margins costs go down, where we were paying $14,000, $16,000 for a shipping container just a few months ago. And then now they're back down to practically pre-COVID levels. So there's 2 ways to look at it. Do we keep our margins high, or do we bring the product prices down? And over the past, those last 4 months of the year, customers are really actually purchasing products that they believe they need. And it became a fun adventure the past 2 years. And, from our perspective, things are only getting better if you've made it this far.
And so we used to call companies unicorns. Last research overview I saw on like CB Insights was about 1,200 unicorns. And so there were the centaurs. I think those were the $10 billion plus companies. We'll see how many actually exist. I think about 50 plus are actually real great companies. But to Max's point, we always call his companies, we were like, oh, you guys are cockroaches. You are camels. Like, you will survive. And you have raised millions of dollars in venture capital, but you've also gotten by in the merit of your company actually having a sustainable business model. And I'll say that again, sustainable is you make enough money, or you've raised capital and you can offset your losses with enough of what revenue you'll have in the future, because you're going to have to buy inventory, and that's a CPG model. You'll sell it later, wholesale. And so money is no longer cheap, proverbially, at least in our generation, going from basically non-existent zero to now close to or about 5%.
Which is from our side, we're working our tushes off the past 2 years. And if you've made it this far, it pays off. But there are words in the business has changed that has spooked startup founders, where profits matter. It's not just hyper growth, over hiring. Everybody was having too much fun in my perspective. If you're, everybody wants to start a business to be on their own hours and their own time, when really I work 24/7, 365, and I work for my customers as much as I work for myself. And, we had to refine our salaries over the years. We had to refine a lot of the dry powder that there's not as much powder out there. So we really had to be smart about every penny we spent. And I think it made the founders that survive today even smarter, but we could even see it's making the larger companies even smarter as well.
Yeah, we always say we wanted those battle-hardened CEOs, and we never want anyone to go through really tough trials and tribulations. This is definitely more macroeconomic. And as we were saying, everything spiked. So your shipping containers went from 2,000, 3,000 to like 18,000, and now they're a little bit more normal, and things aren't getting held up as much. And so this was something that happened to a lot of the tech stocks. They went back down. But with the layoffs, this is because we see a precedency to all these different value, not value, projections. And it's like, great, we're going to grow this much year over year. We're going to hit these revenue numbers. Of my 30 investments, only 3 have actually hit their revenue projections within 3 to 5 years. And so you're looking at these massive, massive companies, at least on the scale of like Microsoft, Google, Facebook, that generate tens of billions of dollars in revenue every quarter. And Facebook was spending way too much on VR and the metaverse. Google, they cut a lot of their R&D. They cut their Google Labs. So a lot of the extraneous expenses that when money is cheaper, you could spend money on, that is now going away, the kind of R&D. Same with Amazon. They were, I think, doing like $66 billion in R&D every year. It's really amazing. Alexa was losing $10 billion a year.
A lot of these large companies had good problems, right? Their profits have decreased.
Right. But they have profits, right? Profits. They have cash in the bank.
The funniest part is that my Roomba's going off and it's making a ruckus in the background. But that is a company that started with the first version that made sense but didn't work well. And then this new version, I'm not giving it any shout out, but it's an excellent product. But of course, it goes off at the wrong time.
Yeah.
But being profitable is now what is sexy. And it also feels good. We finally hit profitability within the past 4 months, but like substantial, sustainable profitability. And when you're a startup, that word wasn't even part of the agenda because there was so much capital to continue growing. I remember we were just looking at some budgets, and part of the budget was raising capital.
Yes.
And as cool as that sounds, it's a terrifying feat because say the powder is dry, say the mountain doesn't have snow, which most of them don't anymore. What are you supposed to do? Your ski resort's going to go under.
Yeah. Okay. Fun little side tangent. Amazon in August of 2022 bought Roomba, the iRobot, for $1.7 billion. You know why? It maps your house. Not saying it's conspiracy or any data, but it bumps around and it maps your house. So it knows where everything is. And so between that, Alexa, and everything else they have on you, they know what's in your house. They can sell you stuff. Okay, tangent, but they still spent $1.7 billion. Hopefully they know what they're doing. It's a great company doing a lot in revenue. And also there's some amazing data in there as well. But to your point, we always joked, right? It was like, oh, money is cheap and control your own destiny. And as an early stage investor, I have said this before and I will continue to say it again. It's my job to invest in companies that will raise more capital. So this is a weird time. And that's why I stopped investing, because the companies that I was looking at could not raise more capital, or I didn't feel that they could. And so I have one company that raised capital and they're doing more revenue than the capital that they've raised, which is unheard of. When you see lots of these tech unicorns, they continue to raise capital and they don't have more revenue than the amount of money they've actually made.
But has your mindset changed? Do you just want a company to be one round bootstrapped? I know we have a few in the portfolio that, they raised 1.5 rounds about.
Yeah.
And then they do some sort of financing fraction. They figure out how to get loans and take on some debt. But are you now looking at companies differently? Are you looking at companies that just need 1 or 2.5 maximum rounds? I know that you see your multiples go up because they raised a round at a higher price, but that's maybe not the way to look at it anymore. And the great, the area that you live in is those companies take 10 years to exit. The ones
Oh
that you're
yeah.
talking about raising more and more and more capital. Do you think one of those capital raises, instead of being a raise, will be an exit, opposed to Series C now? Is that an exit that you see instead of a Series D and beyond? An
Yeah, it's a
IPO, of
great
course.
loaded question because there's a lot of different answers to it. And the first one is traditional venture capital is you raise pre-seed, seed, series A, B, C, and then in the last few years, SoftBank, Tiger, and all these other VCs, E, F, G, H, I, J, K, L, M, N, O, P. And so they just didn't have to IPO. They didn't have to answer to the markets. And so you're right. It took a lot longer. The average exit used to be like 5 to 7 years. That was kind of maybe a little bit too soon. Now it was closer to 7 to 10 years because they stayed private longer. And so still am on that train. It's only been a year-ish of this new world that we're living in, but we know that it's changed. Do I want my companies to only raise one
Yeah.
or two rounds? So if I raise a fund, and for my friends who have funds, you need somewhat of a mark to market. So the answer is no, I don't want them to raise new funds. Hopefully they can raise revenue, but money cheats time. If they raise it, they can hire, they can spend, so they can buy inventory. It's somewhat of an
I'm
unfair
going to
advantage.
step in. Money cheats everything. Time is one thing, and we all know time is the most valuable. But I used to throw money at my problems. I used to hire people to solve my problems. I used to not take the course or not try and learn or have somebody else do it for me to solve my problems. I was doing all of my own sales, but I had a few different sales channels, and I was hiring people to figure out those sales, these sales, and I take care of those sales. But I sometimes called this money toxic money. You raise money, you get all the fame, the glory, the PR. It sounds cool, but I've always learned, no matter what, always have a bootstrap mentality, no matter how much money you raise. And I think that's what these hardened times do to us founders. Because if I had, the money I raise now, I would be in a,
You'd be dangerous.
I'd be dangerous. Now, being incredibly conservative because we don't know what the future holds, and now that we realize that everything could just shut down overnight, you have to know that over here. You hope it doesn't happen again. But from the other perspective, the opposite of that is things, Americans and the world are like goldfish, man. We forget things real quick. I never thought we'd blow out candles on a cake again.
Oh yeah, pick them.
No issue. People go right back to it. So I don't know if this world that we live in goes right back to it, but I know I've changed.
I think we all have. And it was well said that we lived in somewhat of a short-sighted type of world because we move so fast. We get updates on what's happening right now. And if something becomes really hot, then everybody dives in. And money, as you said, right, can be toxic. Oh, you're doing really well. You're only doing like $1 million in revenue. Sure. Here's $20 million on $100 million valuation. Good luck, because that 20 million to $1 billion plus funds across 2 or 3 different funds, a little bit of a party round, maybe a $5-10 million check out of $1 billion fund. It's a lottery ticket, but that's also the business they're in. So I can't fault them for it. We definitely had some transient new money, new investors come in and kind of blow it up a little bit, but they weren't the complete issue
Everyone was
that we
making
can blame it
money
on. Everyone was kind of making money, and the press was loving it.
so
The
long.
companies sounded great, and we wanted growth. We were in the growth world, and now growth at all cost is gone. For now, as you said, we'll forget, and we'll get back to it eventually, and we'll party again like it's 99.
But the founders that are going to come out of this, with all the battle scars, but also let's think about all the laid off people that started in these startups. I got to see the founders or the CEOs of these startups in 5 years go from nothing to $1 billion companies. So they learned so much. I've never actually worked a corporate job or worked inside of a startup, and I know how valuable that'd be for me if I did, right? Looking back at these things, I feel like almost a third time founder in my own business. I know I've mentioned in the past, I feel like a second time founder. But now that I'm on the other side, we're profitable. I now have my financials down to the T. I could practically be a publicly traded company of how great and my financials and projections are. I used to josh around and say, give me,
Hmm.
when investors go, give me your most accurate forecast. And I go, that's an oxymoron. Yeah, I mean, which way is the wind blowing? Yeah, it's one of those things that you just, you're throwing darts on whatever the outcome is. But now I'm going to give you realistic, and then I'm going to give you worst case scenario, and then I'm going to give you if something clicks, right? If I go viral over here, if something great happens over there, or if a partnership that you've been working on for over a year ends up coming to fruition. How many
Yep.
companies tell me, yo, we have this great, test, we have this great partnership, we're in 400 of those, 200 of those, but nobody understands those all fall through. I don't mean to say all of them, but I've been in every major retailer. And I actually, ironically, pulled my products out of those companies because I don't want to play in somebody else's arena. When
Right.
the
Just
times
because you had
go
the
bad, you
partnership.
can't control your destiny. And then when they
Right.
all get capitalistic on themselves, right? When I was working with Walmart, they allowed you to be a little bit late. And then 8 months later, they go, no, it's your problem. And if you don't fix it, we will ding and dang you, if not even kick you out ourselves.
Yep.
So,
Yep.
I took it out, and I hate to use the word pivot per se, but we went full throttle direct to consumer, to control the destiny, that at least the most control that we could get. Let's just say that, because we're still playing with the Spotify,
Controlling chaos.
playing with the Amazons of the world, which ironically at the end of Q4 completely changed my entire business model, because they lowered all 80% of their vendors. Apparently, they lowered their inventory limits dramatically. We all depended on those things. And we had to fight our way to figure out how to make it work. And so, I had to do fulfillment through my own fulfillment centers, which tax on, it hits the margins a little bit. But, the margins might have hurt over here, but they were getting better over there. And then hopefully, and not hopefully, when and if, when things start evening out with all the execution we put over the years, all the advice you and my advisors have given me, everything I've read all over the internet. I'm just thankful that, the crazy part about a startup is every accomplishment is the CEO's, and is the team's, of course, but it all comes down to, yours truly. So
Your
it
vision.
feels good making the hard decisions of firing people you don't want to fire, taking on responsibilities and roles you didn't want to. But the coolest part is when you look at your budget and your operating expenses, you don't realize how much fluff you are adding to it to make your life a tad bit easier. I don't mind working a Saturday. I don't mind working a late Friday. I don't mind working 24 hours on a Monday anymore, because back to the accomplishments, everything that gets done now comes back to, more me. And do we want to blame team members for success? Absolutely. That's why I use the word blame. I blame you for my success. But when you don't have those team members anymore, you have to blame yourself for the success, and you have to just keep
Yep.
fighting and keep trying to. I've learned margins, one, two, revenue, solve all problems.
It definitely helps. And never want to sugarcoat it. Layoffs suck. But to your point, the world has changed. It keeps fluctuating. And these companies have to shore up their capital. They have to get back on their revenue. They have to lower expenses. And what they thought the world would be didn't really come to fruition.
I,
And
I never, you could have quoted me on this. I never thought container prices were going to come back down this low.
right, it just is crazy. There's a container, you check a box, you call someone, they ship it across the sea. It gets picked up, ocean, and then it goes to the warehouses. It's amazing what happens without being there.
Yeah.
And
Everybody goes, how do you do
there
that?
are brilliant people whose lives depend on it. Bless them. And the people in the ports and the authorities that make this work. It truly is like being a cog in the machine, just seeing, at least from your perspective and some of our consumer investments, like what it takes to build something physical.
What about your software investments, the ones that don't have physical presence? Are there things that have changed? Do they continue to have to raise money? Because from my understanding, once you have a software, obviously you have to keep critiquing it, getting smarter. And, I'm all about outsourcing a lot of the work, and I know a lot of that has happened in the U.S. I just got pitched a company who does outsourcing to Mexico for one-third the price of engineers and one-third the price of any position you want. They're all college educated, and I don't mean to degrade any other countries, because when you're in America, you want to hire Americans, right? And the time zones are a little frustrating, but you get used to it just like anything else. I'm up at the ass crack of dawn because half my team's in India now. I don't know if, since this podcast we last spoke, I've hired a CFO and a CMO who are the most excellent people I've ever worked with. And the coolest part is they're proud to work for me every single day. Every
You do a
single
great job.
Right. And, as a CEO during COVID, I was honored to keep my employees employed. I was honored to keep them, busy. But once we all came back to the office, ironically, that was the sad part where I realized, holy cow, I'm doing 80% of all your work anyway, on top of doing all of my work. And that's what really gave me I mean, I did have mental breakdowns, as I don't want to all seem all happy and trying to Trace. I'm very lucky to have him, that he understands it from both perspectives. One, he's had startups and was a founder, and two, what's special about Trace and what he does, which most investors do not do, is he reaches out to his investments. He makes sure that the physical
Actually,
health,
this is the new symbol now.
but the mental health of us is not fun. And the Trace was excellent. I had other founders that they know we're brothers, and when I bump into them, they go, "Your brother felt like he was hugging me on the other side of the computer, the other side of the text," and I needed that hug.
Yeah, big virtual hug. Love you, bro.
Yeah. Has any
Um,
company gone under?
so to your question, right now, I think the most popular word, probably an email, call, text, and I'll make it more popular on social, is runway. How long do you have? Because you can't raise more capital. I have one company that is raising capital right now, and they were like, "What's a good public comp?" And so I said, "Well, I have my friends who would be interested in this." I put out some feelers. Somebody was interested, so I made an introduction, and they asked questions. They're like, "Great, what's your runway? I think you're going to raise too much capital. You need to cut some costs, and you have to be profitable." And we're like, wait. Your public comp is a CPG company that has negative 40% margins, and you want the pre-seed seed company to be profitable. So we used to say half your revenue, double your expenses. Now it's the exact opposite. It's like double your revenue, half your expenses, and that's what we expect of you, to do basically more with less. And so the other problem is they're all cutting back because they have to extend their runway. But it's a fine line again. It's like, if you cut back, you don't have the virality. You can't buy customers. You have to figure out what your CAC and LTV is. But you could extend your runway, but you're kind of just prolonging, not death in some sense, but I have another company that's actually increasing their spend because they need to hit certain metrics. So they cut their runway in half, because why would you drag it out? You're either going to hit your numbers or you're not. And to your question about software, we do pre-seed seed. So a lot of the companies are like a version 1, 1.2, if they have a product, and they have their pilots, their betas, their alphas, and sometimes it's not the right product and it doesn't do what it's supposed to, or it's the right product but doesn't have enough, so it's not differentiated enough.
They built something for themselves and didn't build it for the customer. I've always hear all the time.
That's another problem as well. Yeah. And then other times they built something, they actually spoke to the customer, and then they pivoted, which is fine. We expect you to pivot, and that doesn't mean completely change it, but like, you learn something, you change the wording, you change the product, you iterate the new innovation.
That's what I call it.
And so software is definitely more scalable.
Yeah.
But right now, it has to be founder-led sales early on. You have to be able to sell it yourself. And if you can't, I think most people are just going to say it's a huge red flag. Unless you truly are an amazing technical product person that can't sell, you should be able to sell it.
Well, the runway part, there's two perspectives. One, I'm going to actually come from the investor side because it ends up being the same morals that I have. The people that do have cash right now will lowball the shit out of you. They will buy your company for 1% EBITDA, one times EBITDA or something like that. If this was 19 months ago, 24 months ago, you could sell your company for 8x your revenue. It doesn't even matter if
Right.
it's profitable at that point.
We don't know what
We
EBITDA is.
all know. We all have the same goal. You and I have the same goal. At the end of the day, we all want to exit, and we all want to have, a fortune that we could enjoy and have fun with. But that fortune's not going to happen now. No matter actually how exciting your company is, how proprietary your business or software is, this is where the sharks are coming to hunt. And it's just not the right time. So when you're saying, make your runway a little longer, my perspective is I'm doing a fine balance, a fine line where we still need the customer acquisition. One,
Hmm.
because we have a business very thankful that has lifetime value of customers that is excellent, and the word of mouth is great. So one person I paid to acquire, either that person actually 60% of the time ends up becoming a subscriber. And then we know just through our own emails and the newsletters, which is our data, which is so important to us. We ask the customers what they've been saying, and they've been telling their friends about our products. We
Yep.
started making everybody an affiliate, where we started giving people affiliate links, and every single one of
It's
our
the
customers
best way to
more
sell.
than once. Let them sell themselves. They'll make $5 for every unit sold after 30 days,
Easy.
after the return policy, of course. And it starts to spread. It's that snowball effect. And those are the effects you have to take advantage of.
7-year overnight success.
Yes. And so you just have to make your runway long enough to survive, to get to the holy grail of when valuations go back up. When, things actually, people actually realize that if you've gone this far after these bizarre circumstances, that you are valuable, that your customers do value your business.
And I just want to clarify when you say valuations go back up is you sell less of your company because right now there's blood in the streets.
Yeah.
And if you look at all the charts, one went parabolic. So like it should never really gone that high. And so it's dropped off. Very few people are investing. There is news that you're seeing probably somewhat delayed and new rounds. I see them. I still get sent deal flow, but it used to be like a fire truck hose, and now it's more like a faucet dripping in the sense of both sides are both at like a stalemate. Like they kind of have money, the VCs. They also don't want to do a capital call on their LPs. And the founders know it's going to be difficult to raise. And they don't want to go out and raise and get denied because it's like, oh, you've been raising your seed round for 6 months. Okay, we know it's weird times. Like you want to time it.
They get a bigger chunk of the business.
So that's the valuation aspect, right? So you could raise a seed that was like 2 on a 10, 2 on a 20. Now it's maybe 1.5 on a 5. So an extra 5, 10, 20% here or a bridge. So we're seeing a lot of seed 2, seed plus, pre-series A. And that's where our companies are just trying to raise another $1-2 million to get to the next round, which normally would be fine.
Yeah.
But some of my companies who are going out to raise now, no question, could have raised a Series A. I would have made introductions. They would have raised millions from me and some other friends. Now, it's just not going to happen. What was in 21 stopped in 22 and hasn't begun again in 23. So
Yeah.
that's what I was saying. I stopped last year investing because I was like, well, if I invest now, is this going to come back in a year? No, I'm waiting it out. And so that's what a lot of people are doing. It's unfortunate, but that's the game that is being played right now.
There is money. It's on the sidelines unless there's something which is great for the investors. It allows you guys to start fine tuning and not just throwing things around.
That's what a lot of people did. It got crazy. We just were like, oh, that's a good idea here. Oh, they're invested. Great. Let's do this.
But major funding for, another taunting task for startups is within the past 2 years, I was getting emails and calls every day from lenders. Every single day. You want inventory lending? Do you want asset
Let's do
lending?
it.
Do you want any lending? And I was like, all right. I mean,
I have so much money. Please, just like, take it.
I took some SPA loans, just the government loans. I'm not going to not take them, of course. You take advantage of what you can. And I actually, ironically, pay mine back. I'm not sure what's going on out there. From my understanding, some people didn't have to pay them back, but I paid very low interest rates, but I do pay them back. But those companies were throwing money at everyone, and I just heard a massive company just took a massive hit. I forgot, Clearco or a company in that world, but I
They
know
were buying revenue.
they were
They were
buying.
fronting revenue for percentage. So if you were growing 10%, they would charge you 5%, and
A
you
lot
got
of
the
this
money up front.
revenue is delayed, and it's just on paper. It's so weird to say that revenue is on paper, but when you work with the major retailers,
Yep.
my cash flow is, order 60 days, 30 days on the water, hits my port, goes to my warehouse, has to hit the retailer's warehouse, and that's where the clock starts ticking. But then I've been talking to so many companies, where somebody reach out. You worked with Walmart. Have they paid you on time? Is Walgreens, they're 50 days over their payments with us. We're being strangled by these companies, these massive, because maybe they have their own cash flow issues. We saw Bed Bath and Beyond right before our eyes go out of business. And I saw it internally where, I'd go down to Union, New Jersey 10 years ago, and it was a gorgeous, luxurious office. And when I started working with them, their performance completely fell apart in front of my face. I started reading. They started outsourcing everything. Next time I went to their office, the plants weren't watered. People
Always
were
trust
late
the
to their
plants. If I see a
job.
founder with dead plants, red flag.
Yeah, and those are the little things you look for. We've always been taught, always look at somebody's plants. If they can't keep them alive, how are they going to keep their business alive? And don't get me wrong, I've killed many plants in my day, but that was because it was just whatever happened. But I did water them, I promise, and I did care.
Yeah.
But they started outsourcing, but didn't do smart outsourcing, and so we see it happen right in front of our eyes. So the expectations for the next 6 months, what are you thinking?
Oh, I was about to ask you, quick fire, 6 months expectations as well. And so it's January 21st. And I think in about 6 months, we are very reliant on the public stock market.
Yeah.
Everyone's saying there's going to be a soft landing. Fed's not going to increase the rates too much. So we're going to get a little bit more used to this as the new normal. Higher rates, companies will adjust. I was watching our video from 4 months ago that like steering these big ships takes time. And so that means every company is based on quarterlies. They end the year, they start the year, they're planning the year now. They were doing their budgets. That's where the layoffs came from. And so they'll cut their costs. We'll find out over the next few weeks during earnings season, how everyone did in Q4. Generally, one of the bigger, more party times for earnings. And then Q1, Q2 are softer, which is why I assume they did a lot of layoffs in Q1 because sales are usually lower now, kind of builds up over time. So I think the stonks, some of them, the better companies, the cash flow, less debt-oriented ones will rise. We know who they are. They're old, stalwart companies. They know how to run a business. Tech IPOs will potentially start to increase, but a lot of them have come down valuation. So like, great. Klarna, I think, went from 45 billion to 5 billion. Stripe went from, at least publicly or privately, 100 billion, 200 billion in the secondary markets, now slashed again to about 67. Same with like Instacart, from 37 down to, I think the last one was like 12. So these are valuations that need to come down because the markets just will not accept it. So
What I learned about valuations is bizarre. Valuations are just made up when it's the public market. I saw a company that was valued at 30 million, but they were doing 500 million in sales or something like that.
was
So
that like Casper in terms of like
something,
their stock? Yeah, they got taken private. So there's
yeah, it's weird, man.
it's like public sentiment, right? Things used to be more fundamental. Then Robinhood came out and they kind of started just gaming the market with whatever retail has. But yeah, like Casper, Blue Apron are doing significantly more revenue than their market cap, but their growth is stalled. People have lost interest in them. They also have a lot of debt. They're not profitable yet. So you can be making a lot of revenue, but if your costs are higher than your revenue, that's now unacceptable. We literally just like 180, which is good, but it kind of just was very fast.
Yeah, what I've seen, what I think for the next 6 months, I have my personal problems, my personal successes, and my personal hopes. But from other, looking at outside into other startups and actually knowing what's going on, technically, the ones that show you their hype on the internet, it's like a relationship of people who always post. You always know there's something weird going on.
If you're 30 under 30, I'm not investing in you.
Almost, there's some impressive ones, I'm not going to lie, but then some of them are, whatever hype happened and it got them on the board, or whatever happened, made them on the list. And
Yep.
God bless, but how many of those 30 under companies don't exist anymore from 4, 5, 6 years ago? That
Most
doesn't.
companies do go out of business. They just disappear.
There's a million companies too, and a lot of us, we don't keep it stuffed, but we're just busy. And there's this new trend to create a community, of course, and we all want to be able to be an influencer and say, buy my product, and they sell out.
Yep.
We all want that. That's the easy way out, but it's the hard way to get there. It's not easy, but from my side, retailers are have their own problems. The internet and shipping is getting more and more expensive. To acquire a customer is getting more and more expensive. I think companies need to start teasing their customers to see how high and how valuable their actual products are to these customers. We're going to have to continue to keep raising prices, even if our costs sort of kind of go down, because we don't know what's going to happen. All these companies were creating new products. I've been telling companies, just focus on your main flagship products. Stop creating new ones. And then I've seen a lot of ad agencies, right, creating either their own products or completely combining with companies to, I don't know if they're equity combinations or mergers or anything like that, but a lot of these agencies now are having tangible products. A lot of these agencies are now.
They want that revenue. They don't want to just go out and get retainers.
And I know one of your great investments was a roundup, right? There's a lot of roundups coming. I'm in a group of mommy bloggers, and a lot of them have their own businesses, but a lot of them are joining forces. I don't know the equities or anything, but they're all joining forces because I'm doing the same.
Power in numbers.
I'm putting them on my newsletter. If I have you coming to my website, I paid for you to come here, I might as well help you sell other people's products. So the good karma, taking affiliate links of their business.
I've seen a few startups that do that. Yeah.
What needs to happen for the next 6 months in order to survive? I think, the tariffs and all the shipping, we've all gotten pretty used to it. There's a lot of weird new schemes coming in to come through Mexico, come through Canada, and send less than 800 pounds or something. There's all these new rules where you don't get tariffs on stuff, but stop with that stuff. Focus on what's working, triple down on it, and then get smart about your spend and make it last as long as possible, but also don't be shy at the same time. So the next 6 months, I think it actually can be pretty steady. I'm not going to say bad or good, but steady.
Right.
If you've gotten this far, just keep doing what you're doing.
Plateau for now.
Perfect way to put it, plateau.
That's what we tell founders. Where I had a founder, they raised a Series A. They were growing. They hit a Series A, and he said in his update, we're not growing. This was a slow month. I had to focus on culture, and I was like, that's expected. I actually want you to plateau. I don't want you to grow because you will break. And this is that point where you need to build a foundation, step back, take care of the actual company. You're in charge. Investors used to have a lot more control. We'll see if they have more covenants and everything else, like legal control moving forward. But for now, you really need to control your own destiny. And if you're raising, just get a taste and see what industry is kind of interesting. CPG,
yep.
Direct to consumer, maybe AI and ChatGPT 3, throw money at it, right? But everyone's kicking those tires.
The ones that made it through this far, we were hearing months ago, for the past 12 months, that the major CEOs of these major corporations were getting fatigued. Can you imagine us on the ground?
Right, they're getting burned out just managing 100,000 people. Right. For shame.
So, back to the companies that survive, it's the founders that survived. And so the people that got laid off are going to start creating new businesses, new iterations of old businesses.
These executives can join startups that they never would have joined before because they couldn't afford them. And they had nice, cushy jobs, which was great. It's a good lifestyle. But now these startups can get amazing executive talent that's being somewhat unlocked, whether they're laid off or they're just leaving. Yep. So it's going to be really interesting times, but things do take time. That's the one thing I want to bestow, that you're not going to be an overnight success. And if you are, hold on to it as long as you can, because that's just the beginning.
But trends are also terrible. Would you invest in Mr. Beast, right? Because what if he dies? his whole company goes under, right?
Proverbial Mack truck, as we used to say. What happens if Google does it? Nah, we don't say that anymore.
No, no. Now it's a dog eat dog world still. I think it's a shark eat shark world, but it's also incredibly friendly at the same time. Everybody
We're
who
all in it together.
everybody had good morals, made it through, and we're trying to combine those good morals to have good karma to create good businesses with great customers who continue to come back.
That's all we can ask for. So we'll end on that high note. So this is Startup Brothers, and we're signing out. We'll see you soon.